Major investor and multi-billionaire Warren Buffett always said, "I knew I was going to be rich. I don't think I ever doubted it for a minute." All you need to do to start investing in the stock market is decide how much risk you are willing to take. Today I'd like to share with you how to get started investing in the stock market. As college students, most of our financial situations don't allow us to be investing thousands of dollars in the stock market, but it's not hard to start getting rich. Your debut into the world of investments only takes 3 steps. First, find out how much risk you are willing to take. Second, find a broker. And third, build your portfolio. As beginners, it's important to give the risk associated investing more evaluation. Low-risk investments are a good place to start. Mutual funds, which are investments where multiple investors pool their money together and the fund invests all that money on behalf of those investors, and that's according to the Wall Street Journal. These are considered low risk because they're highly diversified, and these are actually the part that I have the most experience in, because when I was born, my grandparents were fortunate enough to help me start my own mutual fund and put money in there every year, so I was able to kind of track how it was doing, and that's what really actually got me interested in how it works and stuff like that. Diversification means that your ownership of shares is spread across a variety of stock in different corporations or in bonds. Put into simpler terms, according to Investopedia, don't put all your eggs in one basket. Higher risk investments include other corporate investments. And you should really consider how much time you have to do the research and background on different corporations before you make a high risk investment, because you should really always know what you're investing in and how that corporation works and how they make their money. A famous example of investors who didn't know how their corporation made money and they invested in it anyways is Enron. And thousands of people lost money by investing in Enron, which turned out to be the largest corporate fraud scheme in American history. Once you have decided on a risk level you are comfortable with, the second step is to find a stockbroker. The first kind of stockbroker I would like to discuss is a full-service stockbroker. Investors make decisions on what kind of stocks investors would like to purchase, and brokers complete the trade for the investor. As a commission fee for a full-service broker, stockbrokers can earn 7 cents per share off of your investments, according to the Wall Street Journal. The second kind of broker is a discount broker. These usually do not require a minimum fee and can be face-to-face or through a firm's online services. Online services using a discount broker can be a great way to get started because as college students, we don't have a lot of money. So they don't charge a huge commission fee because it's online, you don't have a lot of personal experience with them. And it offers you the freedom to play the market and see how it works and do more on your own. Now that you've decided on how much risk you are willing to take and you found someone to help you, it's time to build your portfolio. A conservative investor, shown up here, has a lower risk and lower capital growth investments than aggressive investors. A conservative portfolio would largely contain bonds and fewer corporate investments. Government bonds, Fortune 500 companies, and Fortune 100 companies are considered conservative investments. Aggressive investors will have higher capital growth investments than conservative investors. An aggressive portfolio, which is shown right at the bottom, would contain approximately 50% high-risk corporate investments and fewer bonds. According to Fox News and Forbes magazine, real estate investment trusts and business development companies are high-risk and high-yielding. And you should really invest aggressively if you believe that the company will be profitable and will do well. And I have a short video to show you about when would be a good time for you to invest aggressively.
Yeah, so kind of given the stage of the market and where we are as a company, we're investing very, very aggressively for growth right now. So that's something that we're very happy about and excited about is we see a window of opportunity with this market where the leaders of the next generation of software are going to be created right now. So we're investing to ensure that Box is one of those leaders. So that's sort of what we're focused on right now.
You made a very high-profile hire today in the cloud space from SAP, a public company. What does this hire indicate about where you're focused right now?
Yeah, so we brought on Graham Younger, who's going to now be the EVP of Worldwide Operations. He was the head of SuccessFactors previously at SAP, so running a...
And And he just goes on to say why he thinks that the company will be successful and how he can compete with other companies that are similar to his. Warren Buffett also said, "Price is what you pay, but value is what you get." There's a price placed on every share of stock that I own in my personal portfolio, but the value is the knowledge that I've acquired through investing over the years. I encourage all of you to take a chance today and start investing to find what your value is. You might be apprehensive, but the risk is worth it. As the CEO of JP Morgan Chase recently said in an interview, "That's why I'm richer than you." Thank you.